Hey everybody, how's everybody doing out there? I hope everybody's staying safe, staying healthy, and keeping their profits fat as the stock market rise takes us through the COVID crisis and defies all reality. But yeah, hopefully you're making some money off of it. And we're gonna try to break some things down here as far as that goes. Just want to start the video off, obviously. Got to do the old disclaimer. I'm not a financial analyst. I'm not a financial professional. Anything in this contained in this video is just purely my opinion and not to be used as advice to make trades. So if you need the advice for stock market or investment advice, please consult a professional. So anyway, okay. Uh, S&P 500. So yeah, like I said, defied all reality, has been very, very resilient. Well, the whole stock market in general, and the Fed fueled money has been fueling this rally and just propelling the stock market up into like this V-shaped recovery we've been having so far. I'm not going to make a call that it's completely be a V-shape completely at the end. Maybe we'll see. But so far, so good, and I don't see really any reason to doubt otherwise currently. So overall, things are looking pretty a-okay. So we're going to break into technicals as to why that is. So we notice the action here that's been happening. We were following a sharper trend line up, and then it has changed into a more gradual sloping trend line. So we've been bouncing a little bit off that so far, and we seem to have found a little bit of resistance up here temporarily. So during the first week of May, or I guess you could say late April as well, we started this little triangle pattern that was bouncing off, and then we ended up breaking through that and breaking out. So it ended up back testing, broke out, and today carried on a little more for the opening of the week. So far so good. It's looking okay. We got a couple big resistance zones that probably won't break out in the first attempt, I'd imagine. So maybe we'll zigzag a little more in here before we attempt a higher breakout. But again, so far so good. And technicals all kind of staying in the bullish zones. Stochastics are ticking up, and we're about to hit the rally zone, so that looks good. MACD didn't even end up crossing and ended up basically faking us out there, and looks like that's going to keep on trending up. Zoom out to the weekly, same kind of deal. MACD's crossed, and obviously when you see a MACD cross, that doesn't mean the market rally is going to continue for much longer or a lot longer. It could, but it's not a guarantee, and we don't count on that too much. But given past trends, we could see more upside potential here. So we're going to watch out for these resistance ceilings here. I would expect at some point we're going to get the MACD maybe over the next few weeks, maybe 4 or 5 weeks, probably come up. Who knows if it trends lower, how long that takes, but we'll have to play it from there, see what happens. Maybe we'll end up getting a little bit of a rounded top and a consolidation before we move higher. But yeah, we'll just play that one by ear. But again, so far, strong weekly candles. I mean, we had a couple that were looking a little iffy in April, but we rallied hard towards the end of April, and May has been a good start. Go to the TSX, same kind of deal. TSX has come up just as well. Same kind of thing. Followed this sharp uptrend. We had a little bit of a pennant here go on before a breakout, and then it settled into this uptrend, which is a little bit more gradual again. And we've been following that up ever since. Held support lines okay, and yeah, we're gonna end up coming up to the 100 and 200 day moving averages pretty soon. So again, I would probably expect that we will bounce around a little in between those before a breakout higher. And if and when that does happen, highs really aren't that much further ahead. So who knows how long it'll take? Maybe we'll get there by the fall. I'm not sure if the present trend line continues. So that's like that's the big if, right? But again, like I said, not a lot of reason to believe that that's not going to happen. And again, we look at the weekly, really strong. A lot of upside potential. I mean, it's we've had a lot of momentum coming out of this. I mean, it's blown away any rally we had before, like even 19. This rally has been a lot quicker and a lot more responsive. We'll have to see what happens here as far as the stochastics, whether they turn here. It doesn't look like they should, but I would expect once we get around these resistance zones and we fill this gap that we're going to see consolidation before we move higher. So again, excuse me, I'm not expecting that to be a sharp drop. And I've said it before in previous videos, the stock market is in inflation mode right now. All the money that the Fed is, well, most of the money that the Fed or central banks in general are printing, a lot of it's going into financial assets, and that is what is propelling the stock market up. And then as that goes higher, we're looking at more funds and hedge funds, that kind of stuff, closing their shorts, and that's what's driving us even higher and higher. So uh, again, it seems like the hedge funds are rather bearish right now, and I'm not putting a lot of faith into that outlook because in 2019 we had a lot of these guys getting really bearish at the well, beginning of the rally. Really, I can't remember exactly what point it was. I think it was right around when we were at the 100-day or 200-day moving average. Sorry, but they turned out to be incorrect, and retail carried it further, and then they had to again close out their shorts, and we just resumed uptrend as normal. So maybe that'll happen again to this time. I mean, so far it has happened like that, and we'll see what happens with these guys and their short positions. So I had a small short hedge on the TSX. I closed that out on Friday, and then the rest of a little bit I had left over just to see what would happen on the open. But I didn't see anything today that would indicate that I should keep that short position open, and it was very small. It was just a hedge, so I closed that out, and yeah, I'm looking for more upside here. I'll go to RSX first. So this follows the RTSI, the Russian Trading System Index. So that's the Russian stock market. This is a exchange traded fund that's traded on the U.S. exchange. So if you trade in U.S. dollars, you can get exposure to this if you like. I ended up buying kind of near the bottom of this. I was pretty bullish on Russia. They have a lot of their macro fundamentals are really good. They have low sovereign debt. Their interest rates are at moderate levels, which actually that is a little bit of a worry for Putin in a way because they have to control the amount of money now that is going to chase yields. So the higher their interest rates, the more attractive their treasuries or their debt bonds are to foreign investors. So Putin doesn't want that money coming in buying the treasury bonds and then the Russians having to pay all of this money out to these foreign investors in terms of interest. So he doesn't want all that money, that hot money flow coming in and then taking money out of the country. And yeah, so I think he put a tax on it. I don't remember exactly what the percentage is, but there is a certain portion of those interest rate profits that would be taxed that actually effectively makes the Russian bonds have a lower interest for foreign investors. So it kind of disincentivizes them from buying the bonds. So it's encouraging more local bond purchases within Russia and just trying to keep the money in the economy, which obviously is a pretty important thing right now when the world has been so cash hungry and particularly dollar hungry. So, but overall, I like the fundamentals of Russia. Things kind of did turn for them recently. They've had a little bit of problems with the acceleration of the coronavirus outbreak. They did do very well initially, and I think they were one of the first countries to completely seal their border to China, and that helped them initially. But eventually, that thing just wormed its way in there, right? I mean, once it had got out of China and got into Europe, I mean, those flights from Moscow to Europe and all those Russian cities are still running, and so that just a matter of time before the virus gets in and gets past those defenses, and yeah, now Russia's having their own breakouts. So I can kind of see that in the way the stock has been, or sorry, the index has been stalling lately. So you can see that we had a really quick rally up, just like the U.S. market, but it has been stalling at these trend lines a little bit. So maybe we'll get a fake out there, and it looks like the RSI is about to tick a little bit lower. We're a little bit lower on the week. Not a huge deal to worry about, but we got very close to filling this gap, so maybe the market's going to decide to take a breather and then head a little lower before we end up testing that support or that resistance line again, that trend line. So, but again, like I don't see any reason to be super bearish on this or anything. It still looks okay. I mean, it's right now it's underperforming the S&P 500, but in long term outlook, I'm more bullish on Russia. So I think maybe I don't know, maybe we'll see 17s, maybe high 15s again, which myself, I will add to my position. I'm pretty confident in it. So, but again, I'm not going to be dishing out advice on that. That's just my view on what I'm going to do. So keep on the macro view, and I'll just check out lumber here. I am a pretty strong believer in the correlation of lumber to the stock market, and we've had some interesting action in lumber. So it bottomed in late March, along with most of the markets, and then had a rise, and then I'm kind of representing that wrong here. So let's go up to the daily chart, and we'll be able to look. So, okay, so it bottomed in. So this was the bottom of the stock market right here, mid-March, and then lumber had a further downward move and made a new low before completing an inverse head and shoulders, and is currently on the way up. So overall, right now, that's good. An inverse head and shoulders pattern is a bullish pattern. Usually it is at the end of a reversal, which we've seen here. So we made that right shoulder, and we've broken the neckline. Now seems to be retesting. Here, I'll put a line here. So it seems to be retesting the neckline here, and the MACD looks like we could end up getting across in a movement, and we'll see if that line holds. I mean, there's no guarantee that the head and shoulders pattern will ensure us a future uptrend, but it is definitely a good sign of a reversal. But we're just gonna have to watch it. Maybe we'll get a bounce down to the 50-day moving average, this blue line here, and then maybe another move back up. And then I'd expect we'd probably bounce around those moving averages between the 200, which is the red one, and the pink one, and the blue 50-day moving average. So get a little action back and forth in there for a little while, while the whole catastrophe with the housing market kind of sorts itself out. So I'd expect, I wouldn't expect huge gains in lumber this year. I imagine it'll probably stay relatively flat, maybe a little bit lower. Maybe not. I don't think making new lows completely will, but that remains to be seen. But again, so far, so good for that. But it is definitely behaving differently than the stock market, which is one thing to note. And I mean, I'm not going to completely say that this is going to follow the market as it always does, because when the Fed is injecting trillions of dollars into the market every month, I mean, yeah, it distorts things and distorts how things would be normally correlated. So I'll take it to wheat. That's one I've been following for a while, and one I've been watching and seeing a large base develop in. So as we've hit this downtrend, we're kind of finishing it off, and we were seeing the support happening here, and we're still coming into this wedge. It's still holding around this area, and this is happening as the indicators are getting stronger and stronger. So the whole MACD is trending up and up. Even as we are hitting a new low, we weren't getting higher, or sorry, we weren't getting lower on the MACD significantly than we were before. And same with here, almost retested the low, and we're still looking good here. So I'm still a good believer in wheat prices, I think. And I think we're at a real fragile state in our economy right now with the way the supply chains have been. Particularly the mobility of labor. And there's a lot of talk about farmers not being able to get labor for crop harvesting in this fall. So that could create problems, that could create shortages, and given that, and you're worried about labor already, you know, we all know from reading the news and watching the weather and how it affects us in our relative areas. My province being a big wheat breadbasket for the country, um, all it takes is a couple months of really odd weather to throw a crop off, and so we're at a really fragile state right now where literally a drought or maybe a really rainy season or a really early snow could delay harvests or make us have a really low quality harvest, and food prices could jump right up quickly. And that could possibly coincide right now, or maybe in the fall as the harvest is happening, with production coming online that is shut down right now. We've all heard in the news stuff about Cargill meat plants getting shut down. A lot of them in the states. Donald Trump had to enact that I can't remember the name of it, the War Production Act, I believe, in order to force those plants to stay open. So plants like that. I'm not correlating meat to wheat, but uh, production, uh, I guess, delays or disruptions having an effect right now, and say when the coronavirus starts to clear up in the summer, and then maybe in the fall, towards the fall when everybody's completely back to work, you have that production ramping up at a time when maybe wheat yields are going down. That has the potential to send wheat prices through the roof. And I believe that when we get a breakout of this red trend line, it's going to go up pretty quick. We're going to hit probably $7 and maybe trend down a little bit back to retest, and then it'll be a gradual uptrend from then on. So I'm really watching for that. And that kind of goes for, I should say, not even just wheat, other commodities. We've all seen in the grocery stores, cattle, stuff like that. So right now, because a lot of these plants are shutting down or have shut down, you see a lot about farmers having to kill their cattle just because they can't afford to feed them. And now imagine on now all you get all those losses, and so there's all that less commodity out there, and I'm going to call cattle a commodity. And now all of a sudden you get these plants opening back up. Now you don't have enough cattle to put through them. That's going to send cattle prices way up, and will send meat prices way up at the same time. So right now we've had this phenomenon that because the meat packing plants are closed, there's nowhere to send the cattle. So the price of cattle has dropped quite a bit, but the price of beef has went up in the supermarket, which is sounds really odd, and you wouldn't think that would happen. But once you take that supply, that piece of the supply chain out of the equation, really disrupts the market, and so that's why we're seeing those odd movements in prices. So that's something to note. Gold was one I'm really looking at. We've come into this wedge pattern. We've attempted to have a couple breakouts on it already, but it has not been successful so far. And I've noted this before. We've had this diverging indicator where we're making higher highs in the indicator, or sorry, higher highs in the prices and lower lows in the indicator. So, or lower highs, excuse me. I'm all over the place with my words today. Jeez. So yeah, when you see that divergence, normally that's not bullish, and I'm pretty sure that gold will correct. And well, how low it goes, I'm not 100% sure. I can't imagine it's going to go down to the trend line again. I would probably expect, the 200-day moving average, maybe around 1560. We hit there. We're going to have some time here, I'm sure, but the Bollinger Bands are pretty tightened up too, so that happens in anticipation of a big move. But we also have this declining downtrend line here too. So if we happen to do get a bounce, maybe in the next couple of days, which I think this will play out this week for sure. If we happen to do get a bounce and break this trend line, then you could see prices go up quite a bit. So I mean, gold could be making new highs, even pushing up towards like 1900, 2000. We'll see. So very interesting to keep an eye on, and I'm going to be studying that pretty hard this week and just watching it like a friggin' hawk. Okay, so one kind of economic topic I wanted to cover tonight, which I saw this article that this guy had posted on Twitter this morning. Yeah, that's right. And really interesting because I had kind of expected this eventually. I didn't know how it was going to show up or what was going to happen with it, but I figured at some point the CMHC was going to be really hit by this coronavirus problem, and they were going to be spending a lot of money to bail out banks for toxic mortgages, which appears to be happening. So there's a little bit of whisper going on in the fact that the Canadian Housing Agency, which is the CMHC, signals it may need a bailout. So yeah, you get, I've been talking about it before. The Canadian housing market is a bubble. It's been a product of bad government policy, which has basically led to improper lending, low standard lending, and just the overall leveraging up of our economy as house prices have gone further up and down payments have gone further down. And it's all been under the guise that this mortgage scheme can keep it safe, which at this point, it appears that that whole gig is up. The emperor has no clothes, and we're just as vulnerable as any other bubble in history. And it's popping. It's going to pop. So you think about why, and you think about why home prices go up. So home prices go up because people are buying, and the more demand there is, and the less supply can keep up with the market, you get higher prices. So at this point, the coronavirus has shifted demand backwards again. Or sorry, not again, but it has shifted demand backwards, whereas supply has been a little bit affected, but not so much. I mean, they shut down new home construction for a little while in Ontario, but I think the rest of Canada and the United States didn't touch their new home construction. They left it as is. So as you have all these homes still being built, nobody's buying them. The banks have lowered interest rates, so that had initial propelling of people into the market as they think they're getting some kind of great deal, which they're really not. They're just buying an overpriced house at the peak for a low interest rate, which they're going to find themselves underwater soon enough. And you're getting that little surge right now, but that's going to be temporary. And I expect probably right away we're going to see people defaulting on their mortgages because all the jobs that have been lost. And if you think about it, all the jobs or a lot of the jobs that have been lost have been in the service sector, which are predominantly young people. And so the less young people that you have working towards their ability to afford a home in the future, maybe even in the near future, we'll see. I mean, if you're a service industry waitress that makes really good tips, you could buy a home off that. Like they definitely can afford really good homes if they're working in a very busy restaurant or pub. So if you have these people not making money towards the future purchase of a house, you're not going to have those people buying houses in the next, say, I don't know, maybe 5 years. I'll just ballpark it. And so that demand shock is going to hit the housing market soon. It might take a little bit of time for prices to really start going down, but they're going to start going down. And once we have that lapse in sales and in demand, you're going to see people probably walking away from their mortgages as their house value drops, which I have also read another article that is already happening in my province, particularly because of the oil shock is basically decimating the oil industry here. So you're seeing a lot of layoffs, and typically, we have the moniker rig pig for people who make a lot of money on the rigs and spend it unwisely, and that includes purchasing houses that they should not be able to afford, but they can because the government has the banks has such loose lending standards based on the fact that the government will bail them out. And that's what's apparently happening right now. And it's gotten so bad to the point where the CMHC, which is the agency that bails out the banks, well, the bailouter needs the bailout. So when that happens, okay, well, you kind of things might be a little bit fucked. So pile that more onto the Canadian national debt, and yeah, good times. So that's basically, in a nutshell, how this whole demand scenario is going to play out. And I think you're going to see a lot of banks taking over mortgages, and prices will drop. Don't know how quickly, but I expect them to drop quite a bit. And that is going to be, I target probably 30 to 40%. In the 80s, they dropped 25%. And I looked at a article about Manhattan real estate prices during the Great Depression. Those things dropped 54%. So it is not out of the question that we could see a over 30% drop in the average home price of Canada. But again, that's depending on location, the employment situation in that location, and maybe the desirability, that kind of thing. So, but either either way, people are going to see their home prices drop, and this is kind of one of the first signs. I would almost call this the countrywide financial collapse in 2007, I believe it was. So I kind of equate this to being that sign, or maybe even just the whisper that it's going to collapse. So yeah, something to definitely watch in the future. And I'm going to be keeping my eye more on the housing market. Oh yeah, I forgot to post Brian Ripley's chart. So Brian Ripley has this great website, chpc.biz. It's Canadian Home Price Charts.biz. And very good graphs. Like, the guy has a lot of useful information, and you can see the revolving home listing cycle that goes on every year. Get summer, winter, summer, winter, summer, winter, and we were hitting a low in 2017 as the real economy was already peaking, and national home sales were basically, the bubble was finishing. It was rounding off, and COVID-19 just popped it. So look at the data now, and we're coming into March when typically March should be on the upswing, and we just nosedive right into the fucking dirt. So it's not a promising look for the summer. Even if we get a small uptick in summer sales, like, really, are we going to end up here before we round off for the winter and end up lower? So that's something to note. So maybe winter would be a accurate or predictable place to say that that would be the start of home price declines. So anyway, I will be definitely keeping my eye on that, and maybe hopefully have some more updates within the next couple weeks on that. And yeah, so anyway, I'm going to post this video on YouTube. I didn't record this on Twitch tonight just because I don't have time to do a Q&A session if somebody wanted to jump in the chat. So I was just going to throw this one up on YouTube, and hopefully on the weekend I'll get around to doing a Q&A and an analysis more in depth about the market. So if you like what you see here, hit the follow button. Be muchly appreciated. I post a lot of analysis on stocks and stuff like that for it, and that's my opinion, of course. Disclaimer. I'm not allowed to give advice. So if you like what you see here and you just want to geek out on some stocks with me, feel free to leave a comment, or you can follow me on stocktwits.com. That's stocktwits.com/Bestiuk. The same name, profile picture, all that. You can find me on there. So yeah, we'll catch you guys next time. Stay healthy, stay safe, and keep your profits fat. Yo, okay, later. Peace.